Jain Resource Recycling Limited, a company that's making a big impact in the world of recycling and manufacturing. They specialize in giving non-ferrous metals a second life, turning them into high-quality products. These products power some of the most important sectors around us. From lead-acid batteries that keep things running, to electrical and electronics that light up our homes, from pigments that add color to our world, to the automotive industry that drives us forward. Company is all set to hit the markets with its IPO, opening on September 24 and closing on September 26. The company aims to raise a total of 1,250 crore, which includes a fresh issue of 500 crore that will go directly towards business growth, and an offer for sale of 750 crore, where existing shareholders will be selling part of their stake. Now let's do company's valuation in this conservative discounted cash flow valuation. I have assumed that the company's revenues will grow at a steady rate of 10% each year, and EBITDA margin will decline from around 5% down to 3%, reflecting a cautious view of profitability. The discount rate applied is 10.7%, which represents the required return by investors considering both the time value of money and the risk associated with these cash flows. All figures are in crores. We begin with revenues, which represent the total sales the company generates. In year 1, revenues are 7,878 crore, and they increase each year due to the assumed 10% growth, reaching 18,600 crore in year 10 and 19,690 crore in the terminal year. Next, we subtract cost of goods sold (COGS), which reflects the direct costs of producing goods and services. COGS is 7,484 crore in year 1 and grows in line with revenues, reaching 18,019 by year 10 and 19,100 in the terminal year. After deducting depreciation, which is a non-cash charge for wear and tear of assets, we arrive at earnings before interest and taxes (EBIT). Depreciation starts at 17 crore in year 1 and gradually increases to 34 crore in the terminal year. EBIT is the profit from operations before considering financing costs and taxes. It is 377 crore in year 1 and grows to 556 crore by the terminal year. From EBIT, we deduct taxes to calculate EBIT after tax, also called net operating profit after tax (NOPAT). This shows the company's operating earnings available after tax obligations. Taxes are 92 crore in year 1 and rise to 136 crore in the terminal year. Therefore, EBIT after tax is 284 crore in year 1 and grows to 420 crore by the terminal year. Since depreciation is a non-cash charge, it is added back to profits to reflect true cash flow. So, depreciation add back contributes 17 crore in year 1 and 34 crore in the terminal year. Next, we account for capital spending, which represents the company's investment in fixed assets like property, plant, and equipment. Capital expenditure is 49 in year 1, fluctuates across the years, and ends at 17 crore in the terminal year. We also adjust for change in working capital, which represents additional cash tied up in receivables, payables, and inventory. In year 1, this outflow is 286 crore, peaking at 418 crore in year 8, and reducing to 223 crore in the terminal year. After these adjustments, we calculate free cash flow to the firm, FCFF, which is the actual cash available to both debt and equity holders. In year 1, free cash flow is 539 crore. It rises to peaks such as 713 crore in year 8 and settles at 660 crore in the terminal year. Finally, we discount these cash flows to their present value using a discount rate of 10.7%. This reflects the principle that money received in the future is worth less than money today due to time and risk. The present value of cash flows is 487 crore in year 1. The values fluctuate based on free cash flow patterns, for example 320 crore in year 5, 316 crore in year 8, and 249 crore in the terminal year. The present value of free cash flows in the high growth phase is estimated at 2,814 crores. This represents the value today of all the projected free cash flows generated by the company during the explicit forecast period, when revenues are still growing at 10% and margins are adjusting downward. In addition, we calculate the terminal value, which represents the value of all future cash flows beyond the explicit forecast period, assuming the company reaches a stable growth phase. The present value of the terminal value is 5,134 crores. Together, the high growth phase and the terminal value represent the total value of the firm's operating assets. From this enterprise value, we then subtract the market value of debt, which stands at 920 crores, since debt holders also have claims on the firm's cash flows. What remains after adjusting for debt is the value attributable to shareholders. This gives us a market value of equity of 7,028 crores. On top of this, we add cash and cash equivalents along with expected IPO proceeds of 180 crores. This boosts the total value of equity in common stock to 7,208 crores. To find the value per share, we divide this equity value by the total outstanding shares, which are 34.5 crores. This results in a per share value of approximately 209 rupees. It is important to note that the IPO upper band is set at 232 rupees per share, which is higher than our conservative case valuation. Next, we will move on to the base case valuation to assess the company under more balanced growth and margin expectations. This analysis is purely for informational and educational purposes. It should not be considered as a recommendation to either buy or sell the stock. In the base case discounted cash flow valuation, revenues are assumed to grow at 15% annually, while the EBITDA margin expands from 5% to 8% over time. Starting with revenue, the company is projected to generate 8,236 crores in the first year. Revenues then grow significantly each year, reaching 28,974 crores in year 10 and 30,713 crores in the terminal year. From this, we deduct the cost of goods sold, COGS, which represents direct operating expenses. COGS is 7,824 crores in year 1, rises steadily with revenues, and reaches 26,656 crores by year 10 and 28,255 crores in the terminal year. Next, we consider depreciation, a non-cash expense that accounts for the wear and tear of fixed assets. Depreciation begins at 20 crores in year 1, gradually increases and stands at 42 crores in the terminal year. After subtracting these expenses, we calculate earnings before interest and taxes, EBIT. EBIT is 392 crores in year 1 and rises significantly to 2,278 crores in year 10, reaching 2,415 crores in the terminal year. From EBIT, we deduct taxes. The tax expense starts at 96 crores in year 1 and grows to 592 crores in the terminal year. After taxes, EBIT after tax, also called net operating profit after tax, NOPAT, is 296 crores in year 1 and climbs steadily to 1,823 crores in the terminal year. Since depreciation is a non-cash charge, it is added back to earnings. Adding back depreciation of 20 crores in year 1, increasing to 42 crores in the terminal year, allows us to move toward true cash flow generation. We then deduct capital spending, which represents investments in fixed assets. These begin at 57 crores in year 1, fluctuate over the projection period, and amount to 93 crores in the terminal year. An adjustment is also made for change in working capital, which reflects additional funds tied up in receivables, payables, and inventory. These remain negative, starting at minus 322 crores in year 1. Peaking at minus 567 crores in year 10, and narrowing slightly to minus 348 crores in the terminal year. After accounting for capital expenditures and working capital changes, we calculate the free cash flow to the firm, FCFF. Free cash flows start at 582 crores in year 1, rise meaningfully across the projection period, reaching peaks such as 2,204 crores in year 10, and stabilize at 2,120 crores in the terminal year. Finally, these free cash flows are discounted back to present value using the discount rate of 10.7%. The present value of cash flows is 525 crores in year 1, fluctuates in intermediate years depending on free cash flow, and contributes 796 crores in year 10. The terminal year contributes the largest share, reflecting the long-term cash flow potential of the business. Under these assumptions, the present value of free cash flows during the high growth phase is estimated at 5,408 crores, while the present value of the terminal value of the firm stands at 16,488 crores. Together, this gives the total value of the firm's operating assets. After deducting the market value of debt of 920 crores, the market value of equity is calculated at 20,976 46 crores. Adding cash balances and IPO proceeds of 180 crores, the total value of equity in common stock comes to 21,156 crores. With 34.5 crore outstanding shares, this results in a value per share of approximately 613. This is significantly higher than the IPO upper band of 232, indicating that under the base case assumptions of stronger revenue growth and margin expansion, the intrinsic valuation suggests substantial upside potential compared to the offer price. It is important to highlight that this analysis is based on assumptions and forecasts, and actual outcomes may differ. This discussion is for educational purposes only and should not be taken as a recommendation to buy or sell the stock. Now let's see the optimistic case in the optimistic discounted cash flow valuation. Revenues are assumed to grow at 20% annually while EBITDA margins expand from 5% to 10%. Revenues start at 8,594 crores in year 1 and rise sharply to 44,345 crores in year 10 and 47,006 crores in the terminal year. After deducting COGS, depreciation, and taxes, EBIT after tax grows from 301 crores in year 1 to 3,498 crores in the terminal year. Depreciation is added back, while capital spending and changes in working capital are deducted, resulting in free cash flows that increase from 471 crores in year 1 to 3,477 crores in year 10 and 3,731 crores in the terminal year. Discounting these cash flows at 10.7%, the present value is 425 crores in year 1, with later years and especially the terminal year contributing the most. The present value of free cash flows during the high growth phase is estimated at 7,733 crores, while the present value of the terminal value is 29,005 crores. Together, these represent the enterprise value of the firm's operating assets. After deducting the market value of debt of 920 crores, the market value of equity is calculated at 35,819 crores. Adding cash and IPO proceeds of 180 crores increases the total value of equity in common stock to 35,999 crores. With 34.5 crore outstanding shares, this translates into a per-share value of approximately 1,043. This figure is significantly above both the IPO upper band of 232 and the values derived in the conservative and base case scenarios, reflecting the potential upside if the company achieves sustained 20% revenue growth and margin expansion to 10%. I am not a Securities and Exchange Board of India registered advisor. This analysis is prepared only for educational and informational purposes. Please consult your registered financial advisor before making any investment decisions.